Welcome, everyone. We're waiting for a few more here, so please bear with us as we welcome people into the Zoom meeting. We'll probably give them a few more minutes and then we'll start. So at that point, they can join us midstream if that's where they are. But we'll give them a couple more minutes. Seems like forever as you sit in silence, but it's only been 1 minute since I said that last stuff. So we'll give them 1 more minute. Okay, well, I think we'll get started. I think what we'll try to do is run through the uh, uh, presentation here. At the end of that, we would like you to kind of hold your questions till the end. That way, hopefully, we'll have answered some of them along the way. And if we haven't, then we can work on that. The purpose of today's discussion is to talk about investment options here at ACF for your funds. And we'll go through each of those options and what they look like. So let's get started. So here's what we're going to try to talk about today. We'll give you an overview of the investment options, which include the long-term pool, a short-term pool, and environmental, social, and corporate governance, or otherwise known as an ESG investment pool. And then we'll talk a little bit about, as our markets become increasingly more volatile, what our investment system is doing in response to that. At the outset, these three investment options or these pools have been created for different investment strategies, which will dictate to your fund a certain risk and return profile or expectation, along with serving different purposes in terms of the individual purposes of the pools. Two of them are long-term in nature, and one of them is short-term. Those long-term pools have investment horizons that exceed 5 years, with an even longer investment time horizon of about 20 years or more. So we're talking about a policy and a pool that will work within those structures. And those three options are there available to do that. The short-term pool is really designed for monies that are expected to be expended within a short period of time, perhaps less than 5 years, where market fluctuations and changes potentially downward in your investment balance would not serve to help the purpose of the fund. So we'll go through each of these. The long-term investment pool is and has been our main pool since 1995. It's the one pool we offered really outside of the short-term investment pool until June of 2022 when we added the ESG pool. It's the subject of our investment policy statement, which we'll talk about here in a second. and its focus is long-term growth of capital with a diversified risk profile. It's fairly conservative in nature. It's designed to uh, grow your fund steadily and carefully over the long haul. It is not designed to hit home runs or to be the Bitcoin of today. It is designed to give you some long-term growth, the preservation of purchasing power, which is important because $1,000 scholarship today is not $1,000 scholarship 20 years from now or 200 years from now. Um, it is diversified across 5 main classes, which we'll talk about here in a little bit. It is here in perpetuity. It's conservative, as I said, and we try to avoid any excessive risk in that portfolio. It is invested in the markets, which means that you will have some fluctuations in it, just as all the markets go up or down. That will happen daily, monthly, quarterly, annually, and through our lifetimes. And there won't be anything that changes that necessarily. The markets will move up and down based on whatever the markets are doing and whatever their particular investment strategies are. So that long-term pool is made up of 53.5% in global equities. Equities are stocks. They are having higher expected returns, but also higher expected volatility than fixed income, for example. And then we also have global fixed income, which are bonds primarily, and treasury inflation protected securities as well, interest rate sensitive and credit sensitive type investments. Both public and private equities and debt are included in our portfolio as methods of diversifying outside of the traditional markets. There are about 9% of our assets are stored in real assets, things you can touch. Those would be things like real estate, timber, commodities, infrastructure, things like that. And diversifying strategies are strategies that we're using to try to diversify the portfolio even further beyond things that are market driven. They are illiquid in nature. They all are sometimes referred to as alternative investments. That's a popular word nowadays. And we're seeking investments that have low correlations to either equity movements or fixed income movements. And about 2.5% of our portfolio in that particular pool is kept in cash to handle any liquidity issues we might have, which are both operational and granting and things like that that are made out of our funds. That long-term pool has a focus. It is growth of capital, as I said earlier. It's a diversified risk portfolio. Its main investment strategy is outlined in our investment policy statement. And the investment policy statement includes also a asset allocation model that we will follow, which is the key determinant in both the risk that we encounter as well as the expected returns that we might encounter. Those are available. That IPS is available on our website. It is the main focus of our investment committee. Our investment committee, I should say, is made up of a number of experts around the state. And those experts meet quarterly along with our staff here and our investment advisors, which is a team of institutional advisors from Baird, R.W. Baird and Company. We have a team of 5 people who are on that investment advisory service, and they advise our investment committee on specific investment recommendations as well as overall asset allocation movements. And those, they only serve in an advisory capacity. They don't do any of the investing for us. That's handled by the investment committee and their decision making. That particular portfolio, here are the returns that portfolio has produced, both as of 12/31 and then most recently as of the end of March of 2024. And you can see that That portfolio produces, if you want to look at the 1-year return in 2023, it was a great year, 14.28%. Previous year in 2022, which were down markets, it was about 13.5 negative. So we do have years that go up and down. Just want to be clear on that. No matter what, when you're invested in the marketplaces, you will have experiences ups and downs within your fund and or directly or indirectly through our investments. Whoops, sorry, clicked off of that too soon. Our balanced index is made up of primarily a 60-40 type environment, kind of. It's 60% world equities, 30% a bond aggregate mechanism, and then 10% in US Treasury tips. That's what we compare ourselves to or benchmark ourselves with. That's that balanced index benchmark that you're seeing there. And the investment objective is a more specific one. They take all of our underlying investments in our investment managers and compare them to a specific investment index that would be appropriate for that particular investment. We have over 18 underlying investment managers that manage that portfolio. This particular portfolio is over $160 million. And so it has a number of different underlying investments. Excuse me. You can see those returns there. The ones that I think are most important are the 5-year returns. And you can see that as of 12/21 or 12/31/2023, that was 8.44%. As of March, the latest tallying, it went down a little bit to 7.93% because that portfolio didn't return above 7% or 8% that year or that quarter. This is a moving target, changes every quarter, and we have that data available to us all the time. You will see that monthly as we post those investment returns in your particular fund as well. So that was our long-term pool. The second pool that we're going to talk about is another long-term pool, but it is our environmental, social, and government investment pool. This particular pool has a different purpose. Its purpose is primarily to select stocks and bonds and other investments with a social lens. It isn't necessarily the same type of investment policy or asset allocation model or design as our long-term pool on purpose. It is social investing. So it has a different meaning entirely. What are they? Well, ESG are primarily 3 criteria. These are a set of standards for how well a company or a potential investment performs as, number 1, a steward of nature. Number 2, how they manage relationships across a number of different platforms, employees, suppliers, customers, communities in which it operates. And then governance is their company leadership, executive pay, whether the board is heavily involved in that organization, rights of shareholders, things like that. But primarily, this is investing with a purpose. How does our ESG pool work? Well, it works using 2 potential screens for any investment. Some of them are positive ESG factors, which are the ones that we just talked about. But does the organization or entity display positive factors with respect to those 3 categories: environmental, social, and governance? If it does, then it potentially would fall under this particular investing option. It then further screens it for what we call a negative screen, which means it will reject entities based on whether they operate in civilian firearms, controversial weapons, oil sands, thermal coal, tobacco, and other things that are associated with a negative screen, which would clear out some of those investments. That pool, this is a comparison between the 2 pools, the traditional long-term pool, which is a more diversified pool, and the ESG pool, which is less diversified. So you can see that the ESG pool is split 60-40 between equities, global equities or stocks, and global fixed income. And that's it. There are no other defining factors. In our traditional long-term pool, there are other diversifying elements within it, real assets and diversifying strategies, which account for 20% nearly of the total. And those will further diversify that portfolio as opposed to the one in the ESG complex. I'm going to give you some specifics of the ESG pool so you can do some educational work yourself if you want. Our ESG pool consists of an exchange traded fund or an ETF, which is a particular ticker symbol. It's EAOR, or EOR as I like to call it. EOR is actually a suite of other exchange traded funds, which are listed here. There are 5 of them. One of which is ESG practices, just ESG favorable entities in mid-cap US stocks, mid-cap Europe stocks, Australia, Asia, Far East, mid-cap emerging area markets stocks, and then small caps, along with the bonds or the 40% of the portfolio in bonds. And they retain a very small amount of money in cash. So you can see that it's primarily a 60-40 split. There are a number of holdings within them. You can see many thousands of different entities that are participating in that particular pool. That's one benefit of it. It's extended across a broad spectrum of entities, but that broad spectrum has to apply or adhere to those screens that we talked about earlier. So why this particular one? Well, it's a simple way to invest in a fairly diversified portfolio using only one fund. It has an access to many global funds and stocks and bonds, and it uses it seeks to establish a long-term balanced portfolio with favorable ESG ratings. Again, ESG ratings or ESG investing is all about investing with a purpose. We want to try to accomplish certain societal things that we think are important outside of the normal investing scenario. Classic one is tobacco, which is one of the screens that comes up as negative, but the classic question that people have asked for probably 30 years is whether you invest in the target tobacco companies like Philip Morris, for example. And maybe you want to do that or maybe you don't. And so if you don't, then the ESG portfolio might fit your model better. And it would be more sustainable businesses as well. And those are some of the indexes or indices that they compare themselves to. Later on, you will get a copy of this presentation where you can click on this blue item down here at the bottom that says, please read the definition for each screen here, and you will get a more detailed version than I'm giving you right here. But the important part to remember is that you're investing with a purpose. It's a diversified, sustainable way of investing in that manner, and that's what that pool is all about. Its returns are slightly different, and you would expect that given the fact that there is a difference between it and our long-term investment pool. Remember, our long-term investment pool is somewhat more diversified, which is both good and bad depending on what's happening out there in the markets. Generally, it has a smoother process of up and down years, but it may also limit those returns somewhat. The ESG portfolio may limit those returns by excluding certain entities and not or including certain other ones. So the fact that they're different shouldn't surprise anyone. This particular fund hasn't been around very long, and so we can only give you data that goes back as far as 2022. But you can compare these to the other one if you want. But again, I would not recommend that because you're investing for different reasons. But basically, this portfolio has returned 4.42% in the current quarter. And the 1-year time frame, it's 13.42. You can see as of 12/31, it was 14.64, which is fairly comparable to our other one, and 9.17 within that quarter itself. Comparing that to a benchmark of basically 60/40, 60% global stocks and bonds, and then 40% aggregate. It shouldn't be a whole lot different from that, other than some of the movements within it. So where can you find out more information about some of these? Well, the long-term pool, again, as I said, is covered by our investment policy statement. That is a fairly detailed document that's available on our website. The ESG pool, you can find more information about that by looking up that ticker symbol, EAOR. Or if you don't want to do that, you can wait for this presentation to be delivered to you. You can click on the blue area and you can find out more about that as well. And then our short-term pool is primarily a money market environment. It accommodates funds that are short-term in nature, that want to expend those funds in less than 5 years, probably. Or if you aren't comfortable sleeping at night with some of the market volatility we see nowadays, then perhaps this one is right for you. Currently, it does pretty well. It's paying 4.5 or 5% roughly, but 2 years ago in 2022, it paid effectively zero. In fact, the fees were more than the earnings. So when interest rates decline, this will decline in nature as well. So just be prepared for that. As of right now, I don't expect that to occur until the latter part of 2024, probably, but that isn't my decision. That's up to the Fed. So let's stop there for a moment and let's ask if there are any questions about the pools themselves. I do have another section here that we're going to talk about market volatility and what to think about when we're dealing with that. But I'm going to pause here and ask if there are any questions that people have at this moment. Well, it's hard to believe that I've actually explained it well enough that there aren't any questions, but we'll continue, and if you have some more later on, we'll chat about that. So, I want to review that our IPS, or the long-term pool specifically, is built for the long term. It is trying to acknowledge that many of our funds here are perpetual in nature. They're endowed. They're here for the long haul or forever. When you make an endowment, you are making a commitment to a forever environment. And that about 60% of our assets are endowed here at the foundation. So let's talk a little bit about market volatility, and I'll give you a trivia question here. So from 1926 to 2022, the S&P 500 composite returned an annual return of 9.7%. Not too bad. Over that same period, how often did the return actually fall between a window of 8 to 12%, which, by the way, is one standard deviation away from the average of 9.7 in any single year? So we have a period from 1926 to 2022, almost 100 years. Out of 91 years there through 2016, it only happened 6 of those years. So it fluctuates widely is the point of this. And I'll show you this chart on the next page, which will visually explain that as well. The green arrows or green bars are where it has gone up, and the red ones are where it has gone down. And you can see that window, though, rarely occurs in that 8 to 12% time frame. But there's one other thing to notice from this. There are a lot more green bars than there are red. And I'll give you another statistic about that coming up. Looking at that same graph, when you look at it, 73.63%, or almost 74% of the time, the markets have gained during the S&P 500. That's what we're talking about here, which is 500 of the stocks within the Standard & Poor's index. That's 3 out of 4 years it's gone up. Then the rest of this graph is talking about the magnitude of those, whether it's 10% or more, either a plus or a minus. And you can see that 58% of the time that gain was over 10%, 36% of that time it was 20% or more. And you can see that the incidence of those is lesser on the loss side as well. It supports the benefit of staying with equities and the equity markets over time. And I'll show you one other graph, and I think this is my favorite graph of all time, when you start talking about the stock markets and the S&P 500. This is the S&P 500 from 1928 up through 2020. And you can see that despite some of the most amazing things happening in this world, whether it was World War II, the crash of 1929, whether it was the oil crisis from the 70s, whether it was the Gulf War, the great financial crisis of 2008, COVID-19 pandemic, the market still went up over time. That doesn't mean that there weren't down years, and it doesn't mean that you can't have one in a narrow window when you look at a 2 or 3 year time horizon. Of course you will. But overall, there is a reason to stay invested in the markets, and this shows you that visually very, very well. What are the takeaways? Well, I think the biggest one is time. Time is your friend. Time is the answer to all of these questions when we're investing. The longer that time horizon, the more likely you will, and you saw that just a moment ago, 3 out of 4, you will have positive results. Again, if you look at a very narrow time frame, that may not hold true. Over a long term, that's true. And that's why our IPS is designed the way it is. That's why our asset allocation model consists of what it does, because we believe that over time, we have the probability of making that return. It's tough to predict which asset class or which type of asset within a class will actually move up or down during the year, which is why you create your portfolio and you stick with it over time. And there's good modern portfolio theory that balances that. In fact, this is what it's all about. Owning a series of assets in some sort of framework. It is established that framework will lower the amount of potential risk that you are subject to, and also potentially raise your return because of those diversified assets. Pardon me. It is the key determinant. So our asset allocation model is built on this type of theory. And that is the key determinant in not only the risk that we encounter, but also the return that we have come to expect from it. Our portfolio primarily is designed to produce about a 6.5% return, maybe 7% return over the long haul. And by long haul, I mean 10 years or more at any one window. So again, if you look at a 3-year window or a 5-year window, you won't necessarily see that. Over time, you will. And there are times where even the 10-year time horizon won't apply. Anybody who has played in college statistics classes have probably encountered that. That long-term portfolio, here's a look at it again. I won't bore you with the actual percentages, but you can see that. I will say that some time ago, we moved in the global equities markets into more passive style investing. That decreases the amount of fees that we have and basically buys the market or accepts the market return in a particular category, like the S&P 500, for instance. But it's not our sole means of investing. As I said, we have private equity and private debt investments as well. I guess the main takeaways about diversification: time is your friend, which we mentioned already. Equities are still part of that mix, always will be. It will be part of the volatility we experience, and we will experience those. And it's not strictly limited to equities. The bond markets have gone up and down with respect to the interest rates and what interest rates are doing and the Fed's involvement. And so we can expect that the bond market will also suffer or have good years as depending on what's happening out there. And the asset allocation model or the asset classes that we're invested in reduce volatility and can have the effect of making overall portfolio returns better. So that's all that I had intended to cover today, but I'm happy to answer any questions that you still might have remaining about any of the pools, some of our investment policies and what they're all about, and how those pools might differ in respect with one another, or questions that relate to investments in general. Any questions?
I have a question. We're
Sure.
we're faced right now with a political climate that could fundamentally change the way the United States operates as far as democracy versus, an authoritarian rule. We have a candidate that's said he's going to do things fundamentally different than we're doing them now. Has anybody given any thought about what that would do to the investment environment in the country? Do you have any thoughts on
that? Well, I think that there are a couple of things here. First off, I'm not going to jump into any political discussion one way or another, but I think
no, I don't. That's not what I'm getting at.
Yeah, I know. The important thing is that the markets themselves tend to react to things that are important to the market. So, as an example, the equity markets in the U.S. are primarily driven by earnings and dividends that companies are producing. What gets in the way of that production of the earnings or things? Well, it can be tax policy, it can be requirements or restrictions within a particular industry that our government may or may not impose. They may be other things that they're reacting to, such as the introduction of new technology, such as AI or something like that. All of those markets and our markets are reacting to these things on a daily and monthly and quarterly and annual basis. Inflation is a problem. Worldwide spending from governmental entities has shown some issues that our governments around the world are dealing with, not just the U.S. government. So what happens with the strength of the US dollar versus other currencies, or the price of commodities such as gold and silver and things like that, or the demand for other commodities like copper, which are used routinely in electronics, or lithium for electronic vehicle batteries, for instance. So there are all these factors that are that the markets have to take into account. They're relatively efficient in dealing with that. And you'll see reactions to them all the time, whether it's the Fed decision today or some other decisions that may or may not influence the markets, or someone will announce earnings that are better or worse than they were expected, and that will have an effect on that particular entity's stock. I think that most of the portfolio management would say that you want to stick with the investments that you have, recognizing that the world changes and that you may have to change those investments over time, but changing them because a particular party or tax policy or something else is about to be enacted may or may not have far-reaching consequences, or it may even be less understood than 5 years from now when those may have been enacted or not enacted. There was a lot of gnashing of the teeth about our well, what's commonly referred to as Obamacare or the Affordable Care Act. And yet it has proven to be very useful for a lot of our society in that people that aren't covered with health insurance are suddenly have a marketplace for that. So there are some things that may have been, you know, looked down upon many years ago that have actually turned out to be favorable in some ways. So I don't really know how to answer that question any differently than that, Paul, but thank you for the question. It's an interesting one. And I think that certainly our investment advisors and our investment committee pay attention to not only macro, but microeconomic things that are going on.
Thank you.
So this is John Pugh from Juneau. Can you give me some examples of the alternative investments that you guys that we're in?
Sure. I'll give you one that I can think of, and it's one of my rather favorite one. But one of them is a limited partnership. It owns a entity that is primarily involved in they call it refrigeration, which is generally large refrigerating warehouses that are either freezer or cold storage related. And they have a unique footprint within that marketplace. You'll see that marketplace growing by leaps and bounds over the last several years, maybe the last decade. Many big companies like Nestle or others that produce frozen things need storage facilities around the world for those. This particular company has a interesting idea, which is that they can save energy consumption by managing the warehouses using robotics as opposed to humans. And the reason they do that is because they inject CO2 into the environment, which is poisonous to humans. So, but it reduces energy consumption by a dramatic amount. And so you can save these companies hundreds of millions of dollars in annual energy costs alone, not to mention that it's much more sustainable from a planetary perspective. And we've done very well in that particular investment. They have a couple of $1 million in it and are looking to potentially invest some more. And it's returned upward of 15% a year for the time that we've been in it. So that particular investment doesn't move with the stock market. It moves with the success or failure of this particular entity. And it's a private equity transaction. We have some private debt funds, which are funds that are primarily loaning money to, generally commercial real estate, although that's not always the case, but sometimes it's multi-tenant housing or larger housing structures. It could be retirement communities, things like that. And those private debt funds are sometimes have an equity wrinkle to them where it's a debt instrument initially, but can be traded in, if you will, for stock in that entity, or can have an equity component in the return. If it exceeds certain amounts, then we get a bonus of some kind. So there are structures like that that are somewhat outside of traditional stocks or bonds, private equity, private debt. Hedge funds, although hedge funds are less popular than they were maybe 20 years ago, we still have a few, but primarily private equity and private debt.
Thank you.
Sure. Any other questions about our three pools or investing in general? I'm not the investment guru, so don't expect me to manage your portfolio. I won't. I do bad enough job with my own, so I don't need to make anybody else's life miserable. No further questions?
Kevin, can I just ask real quickly, if these ESG funds, are you grading them at the foundation there, or is that being like, how are they scored?
Yeah, good question. So the ticker symbol that I mentioned, EAOR or EOR as I like to call it, is the main wrapper around that particular exchange traded fund. It is offered by BlackRock, which is a pretty large leader in ESG in general, but it's something they call iShares. And that exchange traded fund has a variety of underlying investments in it, as you would expect. It actually has 5 different underlying other exchange traded funds. Whoops. Let me see if I can find that slide. There it is there. And so they're the ones making that decision with respect to inclusion or exclusion of any particular entity or holding. And they have a variety of processes that they go through. If you want to drill down into that, you can read a document that's, oh, I don't know, a good 100 pages long. But primarily, they're using a positive and a negative screen. A positive screen for whether they exhibit ESG characteristics, a negative one for whether they are part of weapons manufacturing, tar sands, thermal coal, things like that, that are generally tobacco, things that are traditional screenings outside of negative screens to exclude a certain group. We tried to find one that would try to meet as many criteria as we could think of. That's a difficult thing in the ESG marketplace. When you look at the variety of options that are available out there, and some of them and many of them have a particular, they lean into any one of those 3 governance factors, whether it's environmental, social, or governance, and oftentimes are focused on some element within one of those. This is a larger offering than that. It probably doesn't necessarily meet any one particular strategy that somebody might have within those, but it does cover a wide swath, and that's really what we were trying to offer. We can't offer very effectively a multitude of choices because then it becomes difficult to move money around. We have over 2,500 funds, and we have to accommodate all of those within our investment strategies somehow. Did that answer your question, Ryan?
Yes, thank you, Kevin.
Yeah, sure. Okay, well, I want to, let's see, there's a bunch of things in chat here. Let me pull that up and see if I can. First question is, we are recording this, and so yes, we can provide copies of those to people. And someone asked how much is currently in the ESG pool. That's a good question. Roughly 160 million, 165 million, I think at last count, is in the larger investment pool or the long-term pool. About 5 million is currently in the ESG pool. And let's see, there's maybe a more specific answer than that. Yeah, 5 million. And then about 20 million is sitting in our money market or short-term pool. And that primarily is because many of those funds are expected to be spent out soon or don't want the risk associated with the other market options. Janelle pointed out something here in the chat, just to me directly, which is that as part of BlackRock's screening criteria, they use a company called MSCI, which is a pretty common larger outfit that does much of this work. Oops, sorry. Okay, well, I don't hear any other questions or see any others in the chat, so I will let you have whatever time you might have for the rest of the day back. Thank you all very much for joining and being supporters of Alaska Community Foundation. We certainly appreciate you.